The most profitable customer at a bank may not be a millionaire. It may be someone earning $60,000 or $70,000 a year with a stable job, a car payment, and a small credit card balance that never fully disappears. This person is not bankrupt, but they also do not have enough savings to escape the system. Every month, they lose a little money to banking fees, credit card interest, loan payments, and expensive decisions made under financial pressure. But when their savings reach around $20,000, something begins to change. They are not rich, but they are no longer completely dependent on their next paycheck. Banks, lenders, and even employers begin to lose some of their power. These are 6 reasons why your first $20,000 can transform your entire financial life. First, we need to make one thing clear. $20,000 is not a magic number that works for everyone. If your essential living expenses are only $2,000 a month, you may need less. If your family spends $8,000 a month, you will almost certainly need more. The number that truly matters is enough money to cover roughly 3 to 6 months of essential expenses. For many middle-income households in the United States, $20,000 falls somewhere within that range. But the greatest value of this money is not the interest it earns. Its greatest value is time. If your car breaks down, you have time to compare repair shops instead of accepting the first expensive quote. If you lose your job, you have time to search for a position that fits your skills instead of taking the first offer out of fear. If an unexpected bill arrives, you can pay it with your own money instead of turning it into high-interest debt. $20,000 will not make you rich, but it may stop you from making every important financial decision from a position of desperation. Imagine the banking system as a toll road. The bank does not need you to go bankrupt, because a bankrupt customer cannot keep paying fees. It also does not necessarily make the most money from the extremely wealthy. Wealthy customers usually have more options, more accounts, and the freedom to move their money wherever they receive better terms. The ideal retail banking customer is often someone with a stable income but very little emergency savings. They earn enough to keep making payments, but not enough to escape expensive financial products. When their checking account is close to zero, one small transaction can trigger an overdraft fee. When their balance falls below a required minimum, a monthly maintenance fee may appear. When they need a car immediately to keep getting to work, they have little time to compare loan offers or negotiate a better interest rate. And when an unexpected bill arrives, a credit card can become the only available solution. Each individual fee may appear small, but when account fees, credit card interest, borrowing costs, and higher insurance premiums are added together over an entire year, the total can reach thousands of dollars. That is the paradox of having too little money. The less emergency savings you have, the more expensive your financial life becomes. And every dollar taken by fees and interest makes it harder to build the emergency fund that would help you escape them. It is a perfect cycle, perfect for the bank, but not for you. Consider a simple example. Your car suddenly needs $1,500 in repairs. If you have an emergency fund, this is inconvenient, but manageable. You pay the repair bill, get the car back on the road, and continue with your life. But if you have no savings, that same $1,500 expense goes onto a credit card. And the problem does not end when the car is fixed. It is only beginning. You still have to pay rent, buy groceries, cover insurance, and handle all your regular monthly bills. That means you may not be able to pay the entire credit card balance when the statement arrives. The remaining balance moves into the next month and begins accumulating interest. An emergency that lasted only one day can become a debt that follows you for an entire year. What makes this even more revealing is that 2 people can use the exact same credit card and receive completely different results. The person with emergency savings uses the card, earns rewards, and pays the full balance every month. The person without savings uses the same card but carries the balance and pays high interest. It is the same financial product. One person is rewarded because they have money. The other is charged more because they do not. An emergency fund does more than protect you from unexpected bills. It prevents one small expense from turning into a long-term financial burden. The cost of having too little money does not appear only on a bank statement. It also appears in the way you think. When you are constantly worried about rent, monthly bills, or the next debt payment, a large part of your attention is already occupied. You can still go to work, you can still hold a conversation, you can still complete your daily responsibilities, but in the background, your mind is running a financial calculation that never fully stops. You are thinking about when the next paycheck will arrive, which bill must be paid first, which payment can be delayed, and how you would survive if the car broke down again. In that state, short-term decisions become much more tempting. You may buy something simply because it makes you feel better for a few minutes. You may accept the first loan offered because you no longer have the energy to compare the terms. You may react more strongly to advertising built around urgency, limited availability, or last chance offers. This is a form of psychological tax. It never appears as a line item on a bill, but you still pay for it through lower quality decisions. A large emergency fund does not make every problem disappear, but it gives you back something extremely valuable, the ability to pause. You can slow down, think clearly, compare your options, and decide that you do not need to make an important financial choice today. This is the greatest value of savings that most people never see. Savings give you the power to walk away. Imagine a woman named Claire. She is capable, hardworking, and has spent years proving herself at the same company. But her manager regularly takes credit for her work, dismisses her ideas during meetings, and repeatedly passes her over for promotions. Claire knows she is being treated unfairly, but she has only $6,000 in savings, a mortgage payment, and a child in daycare. She does not stay because she lacks courage. She stays because the numbers do not allow her to leave. Then Claire's savings grow to more than $20,000. Within a few months, she begins applying to other companies, receives 2 job offers, and decides to resign. Her employer immediately offers her a higher salary to convince her to stay. What changed? Claire's skills did not change. Her experience did not change. Her intelligence did not change. The only thing that changed was that she was no longer trapped. This is the power of having a real alternative. When you know you can walk away from a negotiation and still cover your expenses for several months, you behave differently. You do not rush to fill every silence. You do not accept the first offer. You do not spend all your energy trying to please the person controlling your only option. And this principle does not apply only to your job. It applies when you buy a car, rent a home, refinance a loan, or choose a service provider. When you have no alternative, the other side has the power to set the price. When you can walk away, the balance of power begins to shift back toward you. $20,000 may not generate a large amount of income, but it can create something even more valuable, the ability to say no. So how do you actually build this emergency fund? The first step is not finding the fastest growing stock. It is not buying cryptocurrency, and it is not trying to beat the market. The first step is understanding how much your current financial system is already taking from you. Review your bank and credit card statements from the past 12 months. Add up every overdraft fee, monthly maintenance charge, credit card interest payment, loan fee, and other borrowing costs. That total is the price you are paying for not having enough emergency savings. Once you know that number, you can begin redirecting those losses toward your own financial security. The second step is opening a separate savings account. Ideally, it should be at a different institution from the bank you use for everyday spending. It should have a different app, a different login, and a clear separation from the money in your checking account. Most importantly, your emergency fund should not appear directly beside the money you use for groceries, entertainment, and daily purchases. This separation creates friction when you want to withdraw the money. That is not a disadvantage. That is the entire point. A little inconvenience can prevent you from turning long-term security into a short-term purchase. The third step is automation. As soon as your paycheck reaches your account, a fixed amount should automatically move into savings. Do not wait until the end of the month and hope to save whatever remains. In most months, nothing will remain because every available dollar will eventually find a purpose. Save first, then organize your lifestyle around the money that is left. Automation removes emotion, motivation, and daily decision-making from the process. The system continues working even during busy, stressful, or expensive months. The fourth step is setting a target based on your actual expenses. Your goal may be $12,000. It may be $20,000. It may be $30,000 or more. The correct number is not whatever someone on the internet tells you to say. It is enough money to cover approximately 3 to 6 months of your essential living expenses. Calculate the cost of housing, food, utilities, insurance, transportation, and minimum debt payments. Then build your emergency fund around the life you actually live. Only after that foundation is in place should the money above your emergency target begin moving into long-term investments, such as low-cost index funds. The order matters. If all your money is invested and you have no emergency savings, one unexpected expense may force you to sell those investments at the worst possible time. You may have to sell during a market decline, lock in losses, or create new debt just to avoid touching your portfolio. An emergency fund does not compete with investing. It protects your investments from panic, bad timing, and forced decisions. It gives your long-term money the time it needs to grow without being interrupted by every short-term emergency. $20,000 will not make you a millionaire. It will not solve every problem in your life, and it is certainly not the right number for everyone. But a large enough emergency fund can change the way you use credit cards, the way you borrow money, the way you choose a job, and the way you enter every negotiation. Your first financial goal does not have to be beating the market. Your first goal should be reaching the point where no one can easily profit from your desperation anymore. Start by calculating your total essential monthly expenses. Then multiply that number by 3. That may be the first financial milestone you need to build. Because savings do more than purchase security. They purchase time, they purchase options, and sometimes they help you regain control over your own life. If you found this video valuable, subscribe to the channel and share it with someone who is working toward their first real emergency fund.